Good evening, everyone. I welcome all of you in the sixth webinar of this current year. I have with me the complete EAC Secretariat, Parul Gupta, Secretary EAC, Khushbu Bansal, Preeti and Sapna. Just to give some background of this Expert Advisory Committee, this committee is one of the oldest technical committee constituted way back in 1975. In that year, we issued 72 opinions. From that year till today, we have close to 1700 opinions issued, which are there in 42 compendiums of Expert Advisory Committee. All these 42 volumes and all these opinions are available technology-wise also on the search engine. By putting some keywords or date of opinion or volume number, you can take the advantage. Any member can take the advantage of these opinions. A lot of knowledge base is there in those opinions. Today, our chairman, Expert Advisory Committee, Dr. Devashish Mitra, is traveling. So he is not with us today in this particular webinar. Today, we are covering certain very, very important topics in this webinar, such as classification of project as inventory or investment property under India's framework, accounting treatment under India's framework of grant in lieu of equity, receipt from promoters of the company for construction of the project, grant for technical assistance, interest-free subordinate debts received from the government, accounting treatment of unamortized portion of grant from government agencies under India's framework, accounting for subsidy receivable under India's framework, classification and presentation of accrued wages and salaries to employees under trade payable or provision thereof, accounting treatment of shareholders loan provided to joint ventures company under India's framework. These 6 important topics we are going to cover in today's webinar, and we have two stalwart of the profession, Dr. Avinash Chandraji, former technical director of ICI. He has over 50 years of vast experience, 50 years, 5 decades, relating to technical advices on various accounting principles. He has been significantly contributing in almost every technical committee of ICI. He is at present is the member of the International Taxonomy Consultative Group of IFRS Foundation. He is a director in XBRL India, special invitee on Expert Advisory Committee, Accounting Standard Board, Committee on Public and Government Financial Management of ICI. He is also advisor to the Government Accounting Standard Advisory Board, GAZAB, Secretariat of CAG, and various committee work group of XBRL International, MCA, RBI, and IRDAI. Our second stalwart of the day is CA Sandeep Shahji. CA Sandeep Shahji is a chartered accountant having 40 years of experience on assurance, corporate practices to diverse range of industries. In past, he has been a member of Expert Advisory Committee and with other committees, board of ICI such as Accounting Standard Board, Auditing and Assurance Standard Board, India's Implementation Committee, and many other groups for the guidance note. At present also, he is actively associated with EAC and other committees in various capacities. The moderator for the day, my dear friend, Mr. Navneet Mehta ji, he is an experienced Vivek Nevatia ji. He is a professional experience of more than 20 years. He is currently a corporate member in Expert Advisory Committee and a member of India's and or IFRS Advisory Committee. He has been an incredible contributor to the various technical committees of ICI. He is associated with EAC for more than 5 years. He has also served as a special invitee of Accounting Standard Board of ICI. He has also been authorized by IBBI as a registered valuer for securities for financial asset. I welcome all of you. And now with this, I hand over the floor to Vivek Nevatia ji and wish you all a very happy learning. Thank you very much. Vivek ji.
You're on mute, Vivek ji.
A very good evening to all the members present. Thank you to Gupta ji for the wonderful introduction to all the panelists and myself present. It's a wonderful initiative by the Expert Advisory Committee to outreach on the opinions which have been deliberated by the committee over the past years. And this serves as a very beautiful insight on the way committee deliberates on the various issues which are pointed out or the complex issues which are pointed out by the companies on India's specific issues. what we will do is we will discuss on the facts of the case and we'll discuss on the opinion and the issues which were deliberated by the committee before the opinion was brought out. We'll stick to the facts which are presented before the committee, and there would be various scope limitations which are also presented when the committee finalizes the opinion on a particular issue. So when we read a particular opinion, we should be mindful of the facts of the case, the specific query, and also the scope limitations which the committee's opinion points out in the first para. I think scope limitations are very, very relevant when you read the opinion, and that gives you a better picture of the context in which the opinion was drafted. Reading the entire opinion should be read from the context of the specific facts which the particular company points out, and that is the beauty of how the final opinion is arrived at. With this introduction, I would now share the screen for the benefit of all. I hope the screen is visible.
Yes.
So coming to the opinions which are being discussed, Gupta ji has already given us a flavor of what issues we will be discussing over the course of the next 2 years, 2 hours on the issues which are there. So coming to the first issue, which is there, this is with respect to classification of a particular project as inventory or investment property under the Ind AS framework. So I will outline the facts of the case, then we will have the panelists deliberate on this particular issue, on how the opinion was arrived. And if any further issues are there, I would probably bring that out for the benefit of everyone and throw some questions for the panelists to consider. So this company was in the business of development of real estate property for sale in the ordinary course of business. Now, there was a particular project which was jointly developed by a municipal corporation and this particular company, which was developed jointly by them, and there was a specific share of each of the two parties, which was company's share of 77% and AMC share, the municipal corporation's share of 23%. Now, the object for which the property was developed by both these entities was to sell the property after development. So this was formalized through an agreement which was entered into by the company and AMC. There was no intention when the project was developed or even after the development that the company would or the AMC would lease out the property after development as per the said agreement. The intention was always to sell. After the project was completed, the company did try to sell the property to recover the cost which was incurred. However, all the attempts which were made by the company failed. The company even went on to appoint a project consultant by the name of Messrs. J. Advertisements were published, but due to certain non-compliances with respect to RERA formalities, with respect to availability of completion/occupancy certificate from authorities concerned, they were unable to fructify the sale. Now, since the project was completed and habitable, what the company did with the consent of the municipal corporation was to rent out these properties which were finished project and generate income in the form of rental income till the sale of property actually takes place. So after the receipt of the occupancy certificate, what the company started doing was it started renting out the properties to generate some other income. The space was also let out to some government authorities. Now, the intention continued to sell in the market and not for let out, and rent agreement was always entered with the tenant for a very short period of time, typically for 1 to 2 years, with a right to vacate whenever the need arises. The temporary rental income was shared by both the co-owners in the agreed profit sharing ratio of 77-23 as we discussed. The company recently, the fact pattern also stated that the company received the occupancy certificate of the project and they agreed that the sale of the project would be launched at the earliest after completing the RERA and other statutory requirements. Now, considering the fact that the company was earning rental income on sale of or on lease out of the properties of the particular project, the question which arose was whether the company should continue to present its share of assets as real estate inventory, or should it transfer to the same as investment property, or any other suitable treatment was required as per the applicable Ind AS. So basically the question was, since the company had developed the real estate as its inventory and the intention was always to sell, whether they would continue to classify it as a real estate inventory, or would they reclassify the same as investment property, considering the fact that they were actually, the fact pattern establishes that they are actually earning a rental income and not presently in the business of selling that real estate, although the intention always was to sell the real estate project which has been developed by the company and municipal corporation? Or do we feel that any other suitable treatment was required as per Ind AS? So I would request Dr. Chandra to take us through the query and the opinion and the way the committee deliberated on it, particularly in light of the definition which is there in Ind AS on inventories, Ind AS on investment property, and what is more suitable in the facts of the case. Yes, Dr. Chandra.
Thank you very much, and good afternoon, everyone. This particular query is a very good example of how one asset can be classified in the balance sheet differently. The asset is the same, but depending on the purpose for which the asset is kept, how it can be classified as inventory or investment property. So if we look at the scheme of the standards under Ind AS, namely there are two standards which are relevant in this particular case. One is Ind AS 40, investment property, and the other one is Ind AS 2, inventories. And both these standards, they focus on the purpose for which the asset is held. So, for example, if we look at the definition of investment property in Ind AS 40, it says the property held to earn rentals. That is why the property is there. Property is held for rentals. The purpose of property is to earn rentals or capital appreciation or both. And then it goes on to say, rather than for sale in the ordinary course of business. So the purpose has been specified in the definition itself, that the property, that is land or buildings or both, should be held to earn rentals or capital appreciation purpose, or for both, rather than for sale in the ordinary course of business. And if you look at paragraph 9 of Ind AS 40, it even uses the word intended, that is, the asset is intended for this particular purpose. In other words, the intention under which the asset is held, that is important. And similarly, the definition of inventory in Ind AS 2, that the inventory is held for sale in ordinary course of business, and there are other requirements also, like it could be for manufacturing purposes and all that. But what is relevant in the context of this particular query is that if an asset is held for the purpose for sale in the ordinary course of business, then it should be considered as an inventory. So therefore, the intention is important. Intention for the purpose for which the asset is held is important. However, it is also important that the intention has to be backed up by some evidence. It's not simply saying that the management intends and therefore we can classify the asset in a way in which you want. So therefore, there has to be evidence as to how you can say that you are managing the property in a particular manner, so as to indicate that whether it is held as an investment property or as inventory held for sale. So the committee went into the evidences also as to from where we can draw conclusions that this should be considered as investment property or inventory. So there were 8 points which the committee felt are important, or rather noted. The committee noted that there are 8 types of evidences which are available to reach a particular conclusion. So the first is, what is the business model of the company in question? So it has been specified in the facts of the case, as these have been read out just before I started, that the company, it is very clearly mentioned that the company is in the business of development of real estate property for sale in the ordinary course of business. So it is very clear that the business model of the company is not to hold the property for rental or for capital appreciation, but it is for sale in the ordinary course of business. In other words, it is not an investment property company. It is simply a company which is developing property for the purpose of sale in the ordinary course of business. The second point which the committee noted, that the agreement between the JV partners, that is the company and the municipal corporation, that the agreement itself indicated that the property is to be sold after completion and not for rental or capital appreciation. So, and then the agreement also included clauses pertaining to, number 1, appointment of marketing agency for sale, and number 2, one of the clauses was that the profit of JV partners is based on the sale proceeds. So the JV partners will earn income from the sale of the property rather than from rentals or for capital appreciation, etc. So that was the second point, that the agreement itself indicated that the purpose of the property was for sale. Then the third point is that even though it was included in the agreement, factually also the company and the JV partner, they did appoint a marketing agency for sale. So that is a fact which indicated that the sale has been attempted of that property. Then various attempts were made to sell the property by appointment, as I mentioned about the property consultants. Advertisements were given in the paper. And at one stage, even there was an attempt to sell the property to the JV partner itself. Not only to the outsiders, the attempt was made that the JV partner, that is the municipal corporation itself, could buy the property. So the property, even though the attempts were made, they could not be sold. The property could not be sold. And the reasons which are given in the facts of the case, that the property could not be sold due to non-availability of completion certificate and the occupancy certificate and some pending RERA formalities. So because of these reasons, the property could not be sold. So that was the fifth indication, that the property could not be sold because of certain reasons. And the sixth fact which has been mentioned in the facts of the case is that pending sale, the property has been let out on short-term basis. The word used is on short-term basis to generate temporary income. So the letting out of the property which has been done is for short-term basis, so that the property does not remain idle until the sale is completed. Just therefore, to obtain some income on a temporary basis, the property was let out. So the letting out was not the main objective of holding the property. The letting out was a matter which was incidental, that the property could not be sold and therefore you are keeping it until sale. So you generate some temporary income. And then it has been pointed out in the facts of the case, 7th, that the company has recently received occupancy certificate. And finally, it has been indicated in the facts of the case that sale of the project will commence again after obtaining RERA and other statutory formalities. That even though right now the attempt may not be made to sell the property because some RERA formalities are required to be completed, but once these formalities are complete, still the sale will be attempted. So in other words, the intention of the company or the purpose for which the assets have been held, it never changed during the course in which the property has been held. So therefore, the property held is for the purpose of investment property, inventory, and not for the purpose of investment property. So this should have been sufficient to reach a conclusion. However, the committee went ahead and then it referred to paragraph 14 of Ind AS 40 also, which is, in my view, was for abundant caution that even if there is some difficulty, because this paragraph is applicable if an entity is unable to decide or clear or that there is some difficulty in deciding in classification between the inventory and the investment property. If there is some difficulty then this paragraph 14 becomes applicable. Then they say judgment, paragraph 14 says judgment is needed to determine whether property qualifies as investment property. And secondly, to exercise this judgment on consistent basis, the entity develops criteria for deciding whether it should be classified as investment property or inventory. And then there is further requirement in Ind AS 40 that in paragraph 75C that when you have developed these types of criteria for the purpose of deciding whether a property is investment property or inventory, then you disclose these criteria also in your financial statements in accordance with the requirement of para 75C. So even if it was not clear, in my view, it was very clear, keeping in view those facts which I read out earlier, that the intention has always been to hold the property for sale and therefore to be classified as inventory. But the committee has, further that even if there is some difficulty, it is up to the entity to apply judgment and then develop criteria for the purpose of classification. So keeping in view all these requirements, the committee ultimately reached an opinion that this property, even though you are currently earning some income from rentals, but for classification in the balance sheet, it should be classified as inventory and not as investment property. Thank you very much.
Thank you, Dr. Chandra, for wonderfully taking us through the opinion and clarifying the definition of investment property and also inventories and the merit of the intention of the particular company to decide whether a particular real estate project should be classified as an inventory or an investment property. Mr. Shah, would you like to add anything to the opinion which Dr. Chandra just discussed?
No, so only two things, and as rightfully Avinash mentioned, that the intention was extremely important in the decision making metrics, because in the fact pattern provided, all the four public notices which they issued were with the reference to sell the property and not with a view to lease. So while the MOU with the JV partner did provide that in case they decide to lease, then both the parties through mutual understanding will arrive at the conclusion. And therefore, the aspect on the fact pattern that there was no evidence that they attempted even to provide for a long-term lease. Point number one. And of course, then we do have paragraph 57, which necessarily has all the conditions for transfer from inventory to investment property or investment property to inventory, as the case may be. And those conditions are pretty stiff, and you cannot just do it at your will. So I think on the overall appreciation of the entire fact, Avinash has very lucidly mentioned that why the condition of continuing to hold the asset as inventory, it was met.
Thank you, Mr. Shah. So I think just to sum up the basic concept of deciding whether a particular item would be an inventory or a particular item would be an investment property, intention therefore plays a very, very important part. I think this has been brought out by Mr. Shah and Dr. Chandra very, very wonderfully in discussing the opinion. And intention should not be on document or on paper. It should be backed by the evidence which the company has in terms of how the company is proceeding with the sale, what are the events which the company has, or what are the decisions which the company has undertaken over the several years to actually undertake the sale and and ensure that the sale contract actually materializes. So these are fact patterns which Dr. Chandra also discussed in the opinion, which are very critical patterns to decide whether a particular item would be classified as an inventory or a investment property. One more point which he brought out was on the question of judgment and how Ind AS on investment property requires us to disclose in the notes to accounts on the judgment which the management exercises, which it has to apply consistently over the several years on whether a particular item would be classified as an investment property or an inventory. So again, I think intention and judgment are two important principles which Dr. Chandra pointed out, and these factors should be kept in mind when we classify a particular real estate project as an inventory or an investment property. So coming to the
just for the benefit of the audience, I may may want to read that specific line of paragraph 57, which reads that in isolation, a change in management's intention for use of a property does not provide evidence of a change in use. So the degree of evidence required is way beyond the management intention. I just thought that, for the benefit.
Very nice, very nice. I think very, very relevant. Thank you. So coming to the next opinion. This opinion is something I think all of us, anyone who deals with Ind AS would be dealing with these issues, especially in a holding subsidiary relationship, or even in a company which is a PSU, and if we are engaged in assurance service, providing assurance services with respect to that PSU, I think this is a very good example of how Ind AS deals with quasi-equity, subordinated debt, equity, in contribution, differentiation of equity and grants. I think if we read the facts and discuss the opinion, this would be a very interesting analysis of how a particular how a government grant is treated and what is actually a government grant. So coming to the facts which are there. So the facts would be, there would be three subparts to this query, and we would take it, we'll discuss the facts and then we'll take it one by one for the benefit of everyone so that the opinion just sinks in with all the participants concerned. So the fact pattern here is that the company which is there has been incorporated for the purpose of designing, developing, implementing, financing, and operating and maintaining a RRTS, a rapid transit system in the National Capital Region of India. So let us take let us read it as a rapid transit system in the NCR region of India. Now, the capital structure is just 100 crores, which has been funded by the central and state government in a particular ratio, such that central government would be having a 50% stake and state government would be having a 50% stake in a particular ratio. Since this is a multi-state RRTS rapid transit system, so there's a cooperation of 4 state governments which are required, and the central government which is required for the purpose of executing this project. And therefore, all the central plus the 4 state governments are contributing to the paid up equity of this particular company. Now, additional funds which are required are being met in the form of grant in lieu of equity and subordinated debt in lieu of equity provided by either by the central or state governments, or in certain cases loans from external agencies such as ADB or other development banks. Now, since the project would be completed in phases, it is not possible for the equities. All the state governments would not be required to fund in equal proportion at all relevant times as the phases of the project gets constructed. So what has happened is this RRTS project is being funded as and when the project is being constructed. So, for example, if the Delhi Ghaziabad Meerut is being constructed, so the funding on the Delhi Ghaziabad Meerut would be funded by the respective state government, which is getting benefited by the Delhi Ghaziabad Meerut route. So, therefore, to ensure the flexibility of funding by the respective state governments and central government always funding, central government also funding, the funding is being done through a mode of grant, keeping a equity at a minimum of, let's say, 100 crores, which is being held in the ratio which has been decided by the center and the state. The additional equity which is brought in by the respective state government, which is being benefited, and the center, is being met through grants in lieu of equity and in the form of subordinated debt in lieu of equity, which is being provided as per the respective project or respective phase being constructed. Now, let us take the example of grant in lieu of equity received from the promoters of the company, which is center and the state government. So we'll take this first issue and then we'll go ahead with the second issue. We'll discuss the first issue first, and then we will take the other issues separately. So the company has received grants under in lieu of equity under the RRTS project, under the Delhi Meerut project. Now, these grants, it has been decided to exempt such grants in lieu of equity received by the company. Just 1 second, sorry. So it has in lieu of equity from Department of Expenditure guidelines. So what is happening is these grants are not falling under the DOE's guidelines definition of the grant. The company is not required, therefore, to follow the GFR provisions, which is reporting of the grants and how these grants have been utilized for the purpose of DOE's guidelines in respect of grants being disbursed by the government. These grants are therefore being treated as in the nature of equity capital contributed by the promoters, by the center, UP and Delhi government, which would be benefited by this Delhi Meerut Ghaziabad corridor, and will not be returned to them. And the same has been shown under the head of other equity in the financial statements by the company. Since this grant in lieu of equity is being provided by the promoters of the company, the same is being shown by the company in the statement of cash flows under financing activities over the period, consistently in line with the provisions of Ind AS 7, para 6. Now, company is showing grants also towards capital expenditure for creation of assets as deferred income and other equity. Now, these grants which are being received towards capital expenditure, the company is applying Ind AS on grants and saying that this would be classified as deferred income. And these are being recognized as income each year over the life of the relevant assets, which is procured with the help of these grants. So what the company is doing is these grants, which are in the form of equity, which is treated as equity by the governments concerned, is being accounted for in the nature of government grants by the company concerned. These grants are recognized as part of other equity in the nature of deferred income, which is being amortized over a period when the asset gets capitalized over the period of systemic useful life of the asset concerned as credited to P&L over the years where the depreciation cost would be debited to P&L. So basically the movement that would happen is from other equity, other equity figure would get reduced and it would be credited to P&L over the period where the asset gets systematically used. Now, the question arose whether this grant, which is received in lieu of equity from the promoters of the company, would it actually fall within the definition of Ind AS on government grants? How would preface or framework to the accounting standards deal with the definition of equity, deal with the definition whether a particular item can be recycled from other equity to P&L other income? Whether this can be classified in some other manner, whether classification as a government grant under Ind AS on government grants is appropriate under the circumstances, considering that these grants were actually in the form of equity contributed by the respective governments, and whether these grants which are being received, the presentation of it in the statement of cash flows is correct. So since these grants are basically being utilized to reduce the cost of the asset which is being procured through the sources which are there, through the grants which are procured, whether this should form part of cash flow from investing activities or cash flow from financing activities, which has been disclosed by the company in its financial statements. So these were the 4 or 5 issues which were raised with respect to the grants in lieu of equity received from the promoters of the company. So I would request Mr. Shah to deliberate on these 4 or 5 issues, and then we'll take the other 2 issues separately.
Yeah, thank you, Vivek. And at the outset, I think, as you rightly mentioned, that the government grants, particularly for the degree of infrastructure development which is happening in the country through the various medium of financing by the central and state government, this EAC opinion assumes great amount of importance because it lays down a very correct principle as to how should be the various characteristics of financing provided by the government or by the state government should be considered, accounted, presented, and then of course the disclosure aspect of it. And as you mentioned that there are 3 limbs to this questions, and the first limb was with reference to the amount provided by the government in the lieu of equity. And so principally we must understand that because these are very large projects where central government and various other 4 state governments were connected, it is not necessary that everybody will provide money by way of equity. And if you put it by way of equity, since the ratios of equity holding was necessary, any mismatch in funding will disturb the entire shareholding pattern. And therefore, the government came up with this idea that instead of giving the financing by way of equity, it will put the money in lieu of equity. And therefore, came a question that what are the implications both in terms of the characteristics of this amount received by the company and its presentation also in the cash flows. So fundamentally, there are 2 aspects which had to be considered. Vivek ji did turn around in the one aspect, which was the DOE, which is the Department of Expenditure. And then we have the general financial rules. These are the 2 of the government rules which also defines in terms of the characteristics under which the amounts have been handed over. So on the fact pattern, the queries had reached out to the Department of Expenditure and who gave up the very clear answer that these are in the nature of equity and therefore are not governed by the guidelines of Department of Expenditure. So this is one part of the clarity which the government provided. Now, the moment you have this clarity, then comes a second set of questions that whether will Ind AS 20 at all apply. And if we look at the scope of the Ind AS 20, any government participation in the ownership of the entity, which is the transaction essentially in your capacity as a shareholder with the company, is from the Ind AS 20. Now, if that is the, with this 2 fact pattern, the received therefore could not have been accounted at all under the Ind AS 20 and had to be treated as the transaction in the capacity as a shareholder, so under the equity would be the first part of the answer, which is being provided by the EAC after considering all the fact patterns which were provided. In terms of the question that whether the under the cash flow, what would be the appropriate answer to be given, and therefore I will read out specifically the Ind AS 7, which says that financing activity. So the question was that whether is it an investing activity or is it a financing activity, the cash flows from investing or financing activity. So the financing activities are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. So because these are non-refundable, these are transactions between the shareholder and the company, the committee notes that the classification as financing activity, the receipt of the funds, should result in the change in size and composition of the equity and borrowings. And since it is in nature of a participation in ownership of the company, the receipt of the same represents the equity contribution from the government and therefore should be classified as cash flows from the financing activity. So this was a very clear answer. I think on the fact pattern, this would correctly be the approach. And because even when originally when IFRS was also framing the IAS 20, they were extremely clear on the fact that the transaction in the capacity of a shareholder cannot result in any distortion of the financial statements, because otherwise the moment you treat what otherwise is an equity transaction between the shareholder as a part of the grant, your entire financial statements will get distorted. So that is one very clear answer which is flowing in. So that was the part one of the query for the benefit of the audience.
Thank you, Mr. Shah. Thank you, Mr. Shah, for wonderfully discussing on how the definition of government grants carves out or scopes out the fact that transactions with owners in the capacity of owners would not be covered within the definition of government grants, and therefore Ind AS would not apply to the transactions with owners in the capacity of owners. Now, since these government grants are in the nature of equity contribution in substance and also not falling within the definition of grants per se exemption as per the Department of Expenditures guidelines, these grants are merely a capital adjustment and capital contributions from the owners concerned, and therefore cannot be treated as grants per se from the from an Ind AS 20 perspective. Now, one point which I would like Dr. Chandra to deliberate on is with respect to the same facts and the same query is on the recognition of deferred income within the category of other equity as these government grants. So whether deferred income can be reclassified to other income from a P&L perspective, from other equity to P&L perspective, maybe if Dr. Chandra could put some perspective on that, that would be very helpful.
Yeah, actually, it has been very lucidly elaborated by Mr. Shah and the moderator that in the current scenario, what you have to see is that even though the grant, even though the funds or the grant, whatever you may call it, is from the owners, it should be further seen that whether these are received in the capacity of owners or not. Many times I have seen in practice that the moment the funds are received from the owners, it is treated as if it is a capital contribution. And you do not see that whether it should be considered otherwise, that is, it could be a liability also, as we shall see in the next query, that the funds contributed by the owner can result into a liability also. So I thought that, this should be upfront. It should be very clear as to the capacity in which the owners have given funds. That is very important, rather than simply the owners giving the funds. So you should also further look into the capacity or the intention of the owner to contribute the capital. Now, coming to the question that once you classify it as capital contribution or include in the equity, whether this can be recognized in P&L as income, as a deferred income. I mean, in balance sheet, it will appear as deferred income, and then periodically, can you transfer it to profit and loss account? Now, it is very clear that something, if you look at even conceptual framework, once something is equity is a residual category, and from equity you don't transfer anything to P&L. You cannot transfer anything to P&L. In P&L, something can go from the liability. That is, if there is decrease in liability, then it is an income. So therefore, from equity, you classified something as equity, some amount is classified as equity, then it cannot be recognized in profit and loss account, keeping in view the principles which have been laid down in the conceptual frame. So from that perspective, a grant, for example, Ind AS 20 talks of the grants being recycled to P&L. But those grants which are within the scope of Ind AS 20, then they are within the scope of Ind AS 20 and classified as liabilities. So once it is out of the scope of Ind AS 20, when it is out of the scope of Ind AS 20, then it is classified as equity. Then you cannot recycle these to P&L. So that is my answer to this question.
Thank you, Dr. Chandra. Coming back to Mr. Shah, sir, if you could elaborate on what other head of equity should be disclosed these government grants which are treated as equity or which are treated as promoters' contribution in their capacity as owners as equity, which is the understanding here. So the company had classified it as deferred income under the category of other equity. Now, what should be the appropriate head under the circumstance? So what Dr. Chandra has pointed out is this cannot be deferred income because it is outside the scope of Ind AS 20. Now, what should be the appropriate head otherwise?
No, I think deferred income under the category of other equity, the Avinash is extremely clear. You can have equity to transfer, but there is no question of equity to income as a transfer. So therefore, any connotation which you use outside, let's say, the share capital, because the Queries, let's say, is a limited company, and therefore you will have share capital, and you will therefore have the other reserves and surplus, and you have other contribution. So appropriate disclosure under this would be in terms of in lieu of equity contribution, with a further explanation to say that what is the nature of this equity, because it will not hit your earning per share, right? So therefore, deferred income is obviously a misnomer. It would ideally be in terms of contribution from the in lieu of equity contribution from government, with further explanation to the notes.
Thank you, Mr. Shah, for clarifying. Coming to the next part of the query, same facts. So what was also contributed by the promoters was subordinated debts in lieu of equity and subordinated debt for taxes and land costs that the company would acquire for the RRTS project. Now, company also received these subordinated debts which were interest-free for the construction of RRTS project from the central government as well as the state government. These subordinated debts were also received in the form of reimbursement of taxes and cost of land, which the company acquired for the purpose of undertaking the project. Now, these interest-free subordinated debts that were taken were repayable after the repayment of interest-bearing senior debts from the development banks that were taken. So these subordinated debts ranked subordinate to the loans which were taken from the development banks, and were repayable only subsequent to the repayment being made to the development banks. And these were interest-free in nature. Further, these the interest further these further the what the company did was, for accounting for these interest-free subordinate debts, they accounted for it at the value at which they were received as a debt. So they did not carry out any fair value adjustment. They accounted for it at the fair value at the amount which they were received. And the reason for not undertaking a fair value of these interest-free subordinated debts was on account of two reasons, essentially. One was that these are in the nature of promoters' contribution in the lieu of equity capital towards the project. And since these are more in the nature of equity contribution by the respective promoters, these are essentially a long-term contribution and long-term subordinated debt, although classified as borrowings, but not requiring any adjustment. This was the company's perspective. The second perspective was that since the company is required to repay only after the loans from the development banks is repaid, the timeline or the tenor of the loan is not clear, because there would be a timeline for the project to be completed. The disbursement or the subordinated debt will continue to be disbursed by the respective governments for the construction of the project. Then there would be loans taken from the development banks for the construction. Then the project would be capitalized and the repayment would start. So the tenor of the loan is not quite clear as to when the loan would actually be repaid. So the repayment date is very difficult to be ascertained, and therefore the fair value cannot be ascertained in absence of their interest benchmark for such ultra long-term debts. Because if you look at the terms of the subordinated debts, the loan from development bank was by itself for 25 years almost, and the project is under construction. So the loan would be repaid. These subordinated debts would actually be repaid at the end of maybe 30 years or 35 years. And there's no benchmark or interest rate available for which a fair value adjustment can be carried out for these subordinated debts. Also, subordinated debts were classified by the company in the statement of cash flows under financing activities. So these were the accounting principles which the company applied for the purpose of accounting for the subordinated debts. Now, once we have discussed this, I would request Mr. Shah to take us whether the company's accounting application was correct in view of the Ind AS, and how the committee deliberated on how the accounting for subordinated debts should be considered. Whether the subordinated debts can actually be classified as other equity as we discussed in the first part of the query, or would it be classified as borrowings, or to what extent this would be treated as a hybrid compound instrument, so as to say there would be a mix of equity, debt, and how would the interest be accounted for? Whether this interest would be accounted for over the years, or how would be the benchmark be undertaken for the purpose of fair value measurement. So these are the aspects which I will request Mr. Shah to deliberate upon. And I know there are a lot of issues, but I'll request you to take it one by one and for the benefit of all the participants.
Thank you. This is another interesting aspect of the interest-free subordinated debt. And for all those who probably would have, carefully read the Ind AS 20, they would have seen that there are paragraph 10A and there is a deletion of para 37. So just to bring the perspective, Vivekji, for the benefit of the audience, until 2008, the Ind AS 20, the IS 20 then had a specific para on 37 that if there was a below market interest rate, there was a contradiction between IS 20 and 39, because IS 20 did not say that you treat the below market loan from the government as a part of within the accounting of IS 20, and therefore in 2008 that's when they amended the IS 20, deleted para 37, which said that you need not do the accounting, and then brought in 10A as the paragraph. So, just from the academic interest, I thought it was important for members to see that until 2008, obviously there was a deviation around the below market rate. And so therefore, the queries has got two points. One is that factually, yes, it's a below market interest rate or zero or interest free subordinated loan. That's one fact. Second fact is that it is only repayable after the principal loans. The third part on the fact pattern was that because this company has more than one degree of project, so the company, the queries felt that there will be further loans taken and therefore there will be a further postponement of the repayment. That was the third fact. Fourth fact was that on a measuring of the fair value of the loan with such a long duration is not yet fully matured and therefore it was not possible to do a fair value measurement. Then the fifth part was that the other contemporary companies were also following the similar practice of not doing the fair value but taking the transaction value as the fair value for the purposes of the interest-free subordinate loan. So these were some of the facts which were provided. Now, from the standard 109, we know very clearly that there is no exception, or in 109 and 113, none of the cases there is an exception that barring trade receivable, everything has to be at a fair value. You will have challenges around observable and non-observable inputs, and therefore we do understand that particularly not only in India, internationally also valuing the long duration loans from government in particularly is obviously because of the multiple factors. It can be on account of the interest rate fluctuations, it can be on account of the credit risk both at the company level, at the the country level. There can be various changes in the market conditions during the long tenure, and therefore there would be challenges, and there are obviously the valuation techniques around long-term government loans have evolved, and of course 113 has the complete disclosure of all the parameters which have been taken into consideration while valuing the long-term loan. So the institute, after deliberating the various fact patterns and the points put forth by the queries, and with reference to the 109, which very clearly stipulates the fair value mechanism, and only difficulty in valuing cannot be the basis for taking the transaction value as the fair value, the expert advisory committee opined that this should be fair valued, and the difference thereafter will be treated in accordance with the Ind AS 20 and in terms of the differing the income over the period of time. So this was the and of course there are various paragraphs around the 109 and 113, which is about about what would be the fair value. So those were all the paragraphs which were considered, and nicely it has been put through. Fair valuation is a must. Avinashji, anything else you think, or Vivekji?
Yes. So Avinashji, I will like you to add on what Mr. Shah has discussed. So mostly on the fair value measurement, if you could touch upon how the fair value measurement would be undertaken, so that would be very helpful. On this,
in this particular situation, as the querist has pointed out, there have been certain practical difficulties, keeping in view the fact that the tenure of the loan is not fixed, it seems, because it is to be repaid only after the principal loan is to be repaid. And then the other difficulties have been pointed out. So these difficulties, the querist has argued, should be considered that the fair value is not determinable. So therefore, the transaction price itself should be considered as the fair value. So if we look at the requirements of Ind AS 113 in the determination of fair values, there are three levels in the hierarchy which have been pointed out. One is the observable fair values, that the prices are available from some markets. So if that is level 1 is considered to be the best fair values for the purpose of measurement. But level 1 may not be available, so you go to level 2. Level 2 is that for inputs, if some other observable inputs can be obtained, which can be used for the purpose of determination of fair values, then you go to level 2. And level 3 are that if you can't go into 1 and 2, then you go into 3. That is, you use some valuation models and on the basis of these valuation models, like present value technique and DCF, etc., you may try to arrive at some fair value. So in the current scenario also, if level 1 and level 2 fair values are not available, then obviously you go to level 3. So the committee has not gone into the question as to how which valuation technique you can use. So this has been left to the entity itself to determine that, keeping in view their own circumstances and facts, they may arrive at some valuation technique which should be used to determine the fair value. So in other words, the short point is that the difficulty in fair value measurement cannot be the ground that you are exempted from measuring the fair value. So that is the main takeaway from this opinion, that you must make an attempt to arrive at the fair value, keeping in view the various factors. And here, as I may just emphasize here, that the fair value is from the market participants' perspective as per Ind AS 113. So therefore, from the marketing perspective, one will have to apply the techniques, whatever they are available, and not simply from the entity perspective. So many times what happens is, why I'm harping on this point is that many times what happens is that company says, I have difficulties, but you have to look from the perspective of the market participants, that how the market participants will raise such a finance, and then how the market participants would consider from their perspective what would be the fair value. So these are the aspects which have to be kept in mind for the purpose of analyzing what should be the fair value determination of these types of loans. So yes, there can be difficulties. That difficulties will be there in most of the situations. Rather, I would say in smaller situation, the fair value will be directly available under level 1. Most of the situation will either fall in 2 or in 3 level. So that does not mean that if you fall in level 3, you are exempted. There are no exemptions from measurement of fair values, except in one rare situation which have been specified in 109, that there also they say that where the cost is a measure of fair value, or cost can be considered as a measure of fair value, then only you can use cost. But otherwise, in other words, the cost itself should indicate the fair value. So therefore, the point is that the fair value measurement is a matter which the entity will itself has to go into in-depth analysis and then try to arrive at a fair value by applying some technique And for this purpose, it is possible that they may have to employ some experts. So that is what I had to add. Thank you.
And Avinash, and therefore the reason that the whole standard 3 is a full standard for the disclosure, right? I mean, like the importance of fair value measurement and the whole disclosure around understanding that you will have level 3 only because it is level 3 does not mean that the valuation techniques have not been deployed. It all that means is that the level of disclosures would be that much higher in terms of the input which you have been considered.
That's right.
So wonderfully put. And I think one takeaway when you discuss fair value measurement was on the valuation from a market participant perspective. That was something which you brought out very nicely. And this is something which is a very big takeaway for anyone who is doing a fair value measurement for a particular asset or a liability. Sir, one important point which we would like you to discuss, Mr. Shah or Dr. Chandra, anyone, is how would the difference between the fair value of the liability and the subordinate debt that is received be accounted for? So in the first query which we discussed sometime earlier, we said that since the grants were in the form of equity, the same was classified as other equity, since the transactions with the owners in the capacity as owners was with the understanding of being in the nature of equity. Now these subordinated debts, the company is saying, or the government respective promoters are saying that these are in the form of equity and would be treated as subordinated debt, which would be repaid after the loans from the subordinate or loans from development banks are repaid. Now, a fair value of this liability, which is a long tenure liability, would definitely be much lower than the actual nominal liability. Now, this difference, how would this be accounted for? Whether this would be classified as other equity, and how would this other equity be ultimately settled or netted? Anything, any perspectives on that? Mr. Shah, would you like to take it?
So this would be difference will be accounted under Ind AS 20 and it will be accounted as a deferred income over a period of the tenure what is anticipated. It will not become a straight other equity.
Dr. Chandra, would you have any perspective on this, please?
Yeah, I think the committee says that since the loans have been given by the government in the capacity of owners, so that is what the committee has concluded. Okay. So anything which is in the capacity of owners is an equity. So there the committee says that it should be a capital, it should be capital contribution of the nature of equity, and that is how it should be classified in the balance sheet also.
Yeah, sorry. That is, you are right. This would become the difference will be an equity and not a deferred income, right?
So are we trying to say that the fair value of the liability which is there would be classified as borrowings, and the difference which is there between the nominal value and the fair value would be classified as other equity?
Other equity.
Yeah.
That's right.
Yeah.
That's right.
So thank you. Thank you, Dr. Chandra, for clarifying. So coming to the next part of the query, I will just put up the screen. Just to put things in perspective and on a lighter vein, we have Dr. Chandra in the expert advisory committee, and it is said that whenever Dr. Chandra speaks, the majority view can become a minority view. So it's always wonderful to have him as part of the committee, and he gives such fresh perspectives, which are very unique. So coming to grants received for technical assistance from ADB, let us discuss what happens when the grants are received not from the promoters, but received from development banks. So what has happened here is, as per the fact pattern, the development banks, apart from providing subordinated debt, apart from providing debt for the purpose of financing the acquisition of the assets concerned, are also providing certain grants for the purpose of capital expenditure. And the amount of grants which are being received from the development banks is required to be used in the RRTS, or the rapid transit system, for certain infrastructural developments, including climate change resilience, environmental sustainability, and certain other purposes which improves the longer term or basically capital expenditure on the RRTS to improve the safety and connectivity, etc. So these would be utilized for capex. I think that is the relevant fact pattern which is necessary. And these capital grants which are being received from ADB are being shown by the ADB as deferred income under the head other equity by the company and being amortized and transferred to income as per Ind AS 20. Now, these grants from ADB are therefore treated as deferred income and is shown as other equity. Please remember the fact pattern. This is shown as other equity by the company and being reclassified from other equity to the statement of P&L as other income on a regular basis when the asset will become capitalized. These capital grants are shown as financing activities in the statement of cash flows. Again, this is a fact pattern which is very relevant and we need to understand whether this is the right practice which is being followed by the company or not. So coming to the query on this particular these grants which are received from ADB, the question which arose is whether the classification as deferred income under the head other equity is correct or not, whether this would meet the definition of grants under the definition of Ind AS 20 government grants or grants which is there, and whether these are appropriately classified in the statement of cash flows as financing activities. I think we could not deliberate on much on cash flows in the last part of the last query also. So we would also request Mr. Shah to put some thoughts on how the cash flows or from these grants would be accounted for and explain how statement of cash flows work. So firstly on grants, then how would the disclosure of deferred income be there and how would this be disclosed in the cash flow statement? So there were three parts to the query. I would request Mr. Shah to take it up, please.
Yes. So on the technical assistance, rightfully as the fact pattern says that the amounts have been provided and whose end objective is for the purposes of building of the assets under the defined objective. So that is one part of the fact pattern, and therefore we have the relevant paragraphs from Ind AS 20, which is your paragraph 24 onwards, which talks about that when the government grants are related to assets, how should it be accounted for in the financial statements and what are the options which are available. So whether paragraph 24 says that either it can be set up as a deferred income or by deducting the grant in arriving at the carrying amount of the asset. So these two policy choices are there in respect of grants which are received for the purposes of acquisition of an asset. And then both the options are acceptable alternatives is what also paragraph 25 mentions. And then, of course, if you set it up as the deferred income, then over the life of the depreciable asset would be the life of the underlying asset would be your accounting in case the choice was to take it as a part of the deferred income. And in the other alternative of reduction in the capital asset would technically mean that your depreciation charge to that extent is lower. So these are the two alternatives which are there, and therefore the accounting wise, as earlier also Dr. Chandra mentioned, that from equity to income is not a choice which is available under the Ind AS framework, and therefore the amounts which are in the category of the deferred income would have to be shown as a liability, and then what you are amortizing within the period of 12 months and beyond 12 months or the operating life cycle, operating cycle, then it will become current and non-current. So this is as far as your classification is concerned. So first view, the EAC has provided this is not other equity. It is deferred income, which is a liability. And once it is a liability, then it will become current and non-current of the amortization of the deferred income. The other aspect which was relevant, that whether this grant, even though is going to be recognized as an income over a period of time, whether is it in the nature of a financing activity or is it an investing activity, and we very relevant paragraph 28, because the objective of cash flows is to have a fair presentation of what is your cash flow from investing and what is the cash flow from the financing activity. So on one hand, you have a grant which comes in, and on the other side, you are investing money. And I would like to specifically give reference to paragraph 28, which is envisaged such a situation, and they've said that the purchase of assets and the receipt of related grants can cause major movements in the cash flow of an entity. And for this reason, and in order to show the gross investment in assets, so irrespective of the policy choice you make, whether you are reducing the asset or you are calling it as a deferred income, in either of the cases for cash flow purposes, paragraph 28 further goes to say that such movements are disclosed as separate items in the statement of cash flow, regardless of whether or not the grant is deducted from the related asset for presentation purposes in the balance sheet. So the EAC did say that considering para 28, the cash flow from the technical assistance grant which came in for build-up of the asset had to be reflected as a separate line item under cash flow from investing activities. So that's as far as the that would be the answer, both in terms of the presentation and in terms of the amortization and the cash flow aspect.
Thank you, Mr. Shah. So, Dr. Chandra, I would request, well, there are so many concepts which are floating, which we have just discussed. I think the committee has been slightly unfair with respect to the allocation of opinions. There are 3 subparts to the second query itself, whereas your query was a very short query on classification of the in the query 1 which we discussed. So, I would request Dr. Chandra to discuss on. So we discussed a lot of concepts on subordinated debt. We discussed a concept of how equity is accounted for and how grants received from development banks who are not promoters are accounted for. So maybe if you could summarize the accounting of government grants in a very in a 2-minute and how the cash flow should also be accounted for would be very helpful for the participants concerned. If you could just do that, I think it would be very, very helpful, because so many concepts we have discussed over the last half an hour to 45 minutes on this particular query. I think if we can summarize it, it would be great.
Yeah, actually, from this particular query, rather 3 queries, 3 in 1 query, the first thing which we can conclude is that first, whether something falls within the scope of Ind AS 20 or not. So if there is a contribution made by the owner in the capacity of owners and it is outside the scope of Ind AS 20, then it goes to equity contribution, which that equity contribution is not deferred income and it cannot be recycled to profit and loss account. So it is out of Ind AS 20. Then in the second case, that is the grant for technical assistance given by the ADB. Here, the difference is that it is received from a third party, ADB, and therefore it falls within the scope of Ind AS 20. So once it falls within the scope of Ind AS 20, and this is a grant as per the analysis which is related to the assets. So therefore, it is to be recognized over the period of the grant, and therefore the question of recognizing either it as a deferred income separately or reduction from the cost of the related asset arises. So therefore, in this particular situation, the grant falls within the scope of Ind AS 20, and then it cannot be shown as other equity because it falls within the scope of Ind AS 20. It is not other equity. So therefore, it is out of equity. Once it is out of equity, it is classified as liability. Then, if it is a liability, the decrease in the liability is income. So that is how we have to look on an overall basis. And in the case of even the third, the subordinate debts, etc., the difference between the grant part, if we have to consider it as a grant part, that is the interest-free loans. That is the contribution by the government, the interest-free factor, to the extent of interest-free loans is a kind of a contribution made. So that contribution, as per the committee, is in the capacity of owners. So once again, therefore, it is out of Ind AS 20. Therefore, that is capital contribution, cannot be treated as deferred income. So in other words, the short point is whether capital contribution is within the scope of Ind AS 20 or not within the scope of Ind AS 20, and on that hinges the accounting for that type of contribution, or whether, or even ADV for that matter, the grant received from third party, once it falls within Ind AS 20, then the treatment is, it cannot be equity, it has to be considered as liability and then recognized over the period of time as income. In the case of, if it is reduced from the cost of the asset, it is in the form of reduced depreciation that the income gets automatically recognized, if it is not treated as deferred income. That's all.
Thank you, Dr. Chandra, for
Let you ask this one question, that whether the subordinate loan, what would be?
Yes, I think we have discussed that.
We have covered, so it will be a financing activity. Yeah, we have covered that.
So thank you for clarifying and summarizing so well. I think this opinion is a very, very good opinion on how subordinated debts in the context of holding subsidiary relationship is also accounted for and can be applied practically in those situations as well. And we practically deal with a lot of cases where a holding company gives subordinated debt to subsidiaries for the purpose of funding of its long-term projects. So these are principles which can be applied in various circumstances and are very, very relevant from a practical perspective as well. So what we do is we go to the next query. Again, the way we have chosen the opinion is we are again covering another case which is related to government grants, again with respect to rapid transit system, but a different rapid transit system and wherein the facts are quite slightly different from the one we just discussed. So coming to the facts of the case. So again, this company is a JV company between the government of India and the state government of Delhi. So, and they have been trusted with the responsibility of construction and operation of RTS again. These grants received by the company are all being in the nature of capital grant for long-term capital assets, are being categorized into two categories. One is grants which are received directly from shareholders of the company, and the second category is grants received from government and other government agencies like the development authorities as part of funding pattern financing plan for execution of metro project. Now, the queries is of the view that these grants are sanctioned by government or government agencies for the purpose of construction, and therefore same are related to assets within the meaning of Ind AS 20 and therefore fall within the purview of Ind AS on government grants. Now, what the company has done with respect to the accounting for these government grants is that what they have done is the amount of grant which has been received, since they will never be refunded to the authority which has contributed as government grant, or the government which has given this grant to the company for the acquisition or building up of the asset. They say that this should form part of deferred income under the head other equity, and since this would never be recognized, since this would never be refunded, this cannot be classified as liability from the perspective of the financial statements per se, and therefore this should sit as part of other equity in the financial statements. And amount equivalent to depreciation is recognized in PL in accordance with para 26. So there is a recycle of deferred income to other income, which is done on a regular basis. So I think we have already discussed this opinion, but again, since we are covering this query also as part of the opinion, we will request Dr. Chanda to again throw some light on why these grants would be classified as liability and not other equity, and maybe cover preface to the standards and framework to the standards also. Maybe very shortly so that we can go ahead with the fourth opinion.
Yeah. I may at the outset mention that these queries have to be are considered by the committee in the facts and circumstances of each case. And therefore, if the facts are different, the opinion can be different. Actually, we have received a question where it has been pointed out that in some other opinion, the committee has reached some different opinion. So I may just, without going into the facts of the earlier situation, because that will require a further discussion and analysis. What I would like to highlight is that the two queries, the two opinions have to be read in the context of the individual cases. So it is possible that in some because of some factors, the committee might have reached some different opinion. So therefore, one need not simply jump to the conclusion that in the same facts and circumstances, the same opinion has been reached. And that is where, this particular query also comes, that even though the principles are the same, which we discussed earlier in the case of earlier opinion, but here we have to again apply those principles in the given facts and circumstances and reach a particular opinion. Now, as mentioned, basically there are two aspects to this particular query. One is whether the grant given by the owners of the company, once again here the grant is given by the owners of the company, is whether it is within the scope of Ind AS 20 or not. And secondly, that if it is within the scope of Ind AS 20, the unamortized portion related to grant is to be presented under other equity or as liability. Now, we have earlier considered the various aspects as to what constitutes the contribution as capital and what should be considered as a grant, etc. Now, in this particular case, the committee looked into various documentation to reach the conclusion that in the current scenario, that even though the contribution has been made by the owners, now this is a very clear fact that in earlier situation, the committee, earlier query which we discussed earlier, the committee reached a conclusion that the contribution made by the owners was outside the scope of Ind AS 20, keeping in view the facts and circumstances of that case. Now, in this particular case, the committee then looked into whether the grant has been given in the capacity of owners or not. For that, the committee has examined various sanction letters, etc., written by the government and government agencies to the queried company. So there, the committee has highlighted some of the facts. For example, what are the terms and conditions? The first terms and condition is that the amount to be utilized for the purpose it is given, and it cannot be directed for any purpose. So that was one of the terms and condition. So in case of capital contribution, the purpose may not be that important. You can use that grant, which is of equity nature, for any purpose you like. And second point, which was noted from the facts of from the documentation, that the unutilized portion of the grant is to be refunded. Now, in the earlier query, it was not to be refunded. In this case, there is a specific requirement that if there is unutilized portion of the grant, then it has to be refunded to the government. And the third thing is that utilization certificate has to be submitted, that how you have used the grant, that certificate is to be submitted to the government authorities. So the expenditure and other things which the committee noted was that in the accounts of the government itself, this was treated as grants in aid. I mean, by in the government accounts itself, they did not say that it is a capital contribution. They treated as grants in aid and accordingly accounted for in the government accounts itself. So therefore, the committee concluded that even though here the grant has been made by the owners of the entity, but it is not as grant, it is not as capital contribution. It is not in the capacity of owners. It is in the capacity of the government giving a grant to an entity. It is in the capacity of a government, not in the capacity of owners. So therefore, it falls within the purview of Ind AS 20. Similarly, the expenditure is treated as grant in its own accounts. So sorry, that I mentioned. Then in the government agencies documentation, in this case DDA, there also they said that you give us a report on the amount spent to the at the end of the year. Then the company should maintain of permanently, semi-permanently assets acquired out of DDA funds. There is a restricted use of grant, and the company the company ceases to exist. That if the company ceases to exist, then these assets are to be returned to the DDA. So the company cannot say that these are my assets, and even in case of liquidation, they can be repaid to some other creditors. They revert to the government agency. And then the grant is to be governed by the GFR rules. So keeping in all these factors in view, the committee decided that even though the government agencies are involved, even though the government is the owner of this company, but here the grant is given by the government agencies and the government as government and not as in the capacity of owners. And therefore, it is within the scope of Ind AS 20. Now, the other part that once it falls within Ind AS 20, that we have discussed in the earlier case, that once it is Ind AS 20, it cannot be other equity, it is to be liability, and then this liability is to be taken to P&L. I mean, this deferred income, what I mean to say, deferred income is a liability, and it is to be recognized in P&L. I will not go into the details which we have already discussed. So I stop here.
Thank you, Dr. Chandar, for wonderfully explaining how the facts differentiate a particular opinion, and the fact that these grants were given by the government in the capacity as government, not as a promoter, with certain conditions attached to which were required to be fulfilled for receiving the grant or for utilization of the grant. And necessary documentations or returns were also required to be filed by the company to ensure the fulfillment of grant is as per the conditions stipulated for the purpose of disbursing this grant. So I think the fact pattern therefore plays a very, very important role, I think, and that is why these two opinions have been discussed together so that the participants become aware that even the smallest of facts become relevant for an accounting decision to be made. So although both the entities, PSU entities, engaged in the business of developing our rapid transit system, are accounting for the amount received from the government in two different manners because of the conditions which were attached or because of the understanding basis which this amount was funded by the government to the company concerned for the development of the RTS. Now, Mr. Shah, would you like to add something on this opinion? And
extremely well laid down.
Thank you, Dr. Shah. Mr. Shah. And now coming to the next query, which is again slightly long. I think we'll be discussing this query and then we'll close the session. But the facts are quite heavy, and I'll just request the participants to focus on the facts because these facts are very relevant for again the opinion to be decided or the accounting or for the committee to decide. So this company is a state government company. which is having 5 subsidiaries, which are DISCOMs, distribution companies. There are 5 distribution subsidiary companies, and the holding company is a state government company with 5 distribution companies as its subsidiaries. The company is primarily engaged in the bulk purchase of power from interstate and intrastate generators, and also bulk sale or supply of power to the DISCOMs. Now, this company has been receiving subsidies from the government on behalf of the DISCOMs under the various schemes such as UDAY scheme and other schemes. And once a subsidy is received by the company, it allocates the subsidy received to the respective DISCOMs in the ratio which is agreed upon with them. Now, there was this UDAY scheme which was initiated in 2015, wherein the debt was restructured and the outstanding debt, 75% was taken over by the state government, and the remaining 25% was issued as state government DISCOM bonds. Now, the objective was, of course, to reduce the interest payout which is being made by the DISCOMs, and to make the DISCOMs financially sustainable, that this restructuring was carried out. Now, state government had sanctioned and released a subsidy of 29,000 crores approximately under the UDAY, which was 75% of the total outstanding debt, amounting to 39,000 as on September 15. Now, there was additional revenue subsidy of 39,000 crores, which was determined in truing up tariff for the period from 7/8 to 19/20, which was for the previous periods, and was payable by the state government to the DISCOMs through the company. So the company was a nodal entity for the distribution of the subsidy from the state government to the respective DISCOMs, and the allocation was basically done by the intermediary, by the company in a particular way, which was agreed upon. So this additional subsidy, revenue subsidy, was amounting to almost 39,700 crores, which was determined in truing up the tariff for 7/8 to 19/20. Now, the company had not done any accounting of this, as there was no reasonable assurance from the state government in this regard. Now, during the year 2021, this aforesaid revenue subsidy to the extent of 29,000 which was received, was adjusted as against electricity dues from the state government and against additional revenue subsidy of 39,000. So, therefore, 25,000 was effectively the amount which was left. Now, after the above adjustment, additional tariff subsidy of 14,000 remained unadjusted. There was a balance amount of 6,000 which was also payable by the state government under the UDAY for 16/17 to 19/20. Therefore, there was a total subsidy of 20,940 crores which was to be received from state government for the periods prior to 2019-20. Now, state government during its budget had ordered that this 20,940 crores, which was not accounted for by the company, will be paid in the next 10 years through the budget, which will be utilized to repay the loan taken from financial institutions. So utilization right now, let's park that utilization for the timing. Basically, this amount of 20,940 crores subsidy, which will be received by the company or DISCOMs in the next 10 years through the budget from the state government, will be received over the next 10 years from today. Now, since the aforesaid subsidy was to be allocated, the company had allocated the same after making necessary adjustment. Now, what the relevant facts the company has pointed out with respect to accounting of subsidy of 20,940 crores, the company is saying that there is a reasonable assurance that this 20,940 crores of subsidy will be received from the state government in the next 10 years from financial year 21-22. And it also says that the company shall comply with the conditions after receipt of fund/amount. So there's no clarity with respect to the facts as to what conditions it is required to comply. It just says that the company is required to comply with the conditions after receipt of the fund or amount. Now, what the company essentially did was it credited general reserve and/or retained earnings and debited receivable from the state government as subsidy receivable. The CNAG in its observation pointed out that this subsidy receivable should have been accounted for as a deferred income. So credit should have been given to deferred income and not as credit to general reserve or retained earnings. So this was the observation which was given by the CNAG with respect to the accounting of the initial 14,000 crores that was receivable. With respect to the additional 6,278 crores, part of it was credited, some entities credited it to retained earnings, some entities credited to general reserve, some entities credited to other income. And so what the CNAG said that this admissible period of Uday loss subsidy has expired in 2021. Further, DISCOMs have already accounted inadmissible Uday loss subsidy receivable from the state government in its accounts for the year ended up to 2021. And hence, accounted for Uday loss subsidy resulted in overstatement of receivable from state government and corresponding credit head. So basically, the CNAG said that this receivable was not a proper accounting, considering that the loss was already expired. The Uday loss subsidy has already expired in 2021. Now, what was the comment or observation of the statutory auditors in the CFS of the company for 21-22? So it says that group has shown 16,940 crores of subsidy receivable from state government as non-current, which is receivable in 10 years as per the state government order. Corresponding amount is credited in other equity retained earnings, and subsidy should, however, be accounted for on an annual basis budget provision release subsidy by the state government. In view of the above, subsidy receivable as mentioned in non-current assets is overstated and other equity is understated to that extent. So there was a observation of the observation of the statutory auditors in the CFS with this regard. Now the questions which were raised before the committee and discussed was what accounting should have been done by DISCOMs in the financial year 2021 in respect of the subsidy of 21,000 crores approximately receivable from the state government. Since the accounts for financial year 21, 22, 23 have been finalized, what would be the correct accounting and which is to be given in the accounts in hand for financial year 23, 24? And if any correction is required, we'll deal with this issue later. I think let us discuss query A and B first, and then we can come to query C later as to how would this be corrected if at all this was incorrect. So let us understand whether this accounting that was done by the company was correct or not correct. I know it is facts, very fact heavy, and too many facts which are put across to the participants. I would request Mr. Shah to just so basically let us focus on the fact of 20,940 crores subsidy which has been accounted for in the financial year 21-22, whether that was appropriate in this circumstance or not. Let us not look at the other facts for the time being, and let us look at what the fact that whether the company saying that the company shall comply with the conditions after receipt of fund or amount is relevant, and whether receipt of the amount is relevant. How would the government grant standard look at this particular fact pattern, and whether this 20,000 should have been accounted this year, previous years, or in the future years? Mr. Shah, I will request you to take this.
Thank you, Vivek. Just to make things little lighter, we will not get overpowered by the quantum of money in the expert advisory committee's fact pattern. So we'll try and stick to the two aspects in this, as Vivek mentioned. So first part is what were the few things which the EAC was required to examine. So first, just from recapitulating, you have one aspect is the tariff subsidy, which means that the DISCOMs are foregoing the price of the power which they are supplying to the targeted customers, where you are taking below market price power and which is getting compensated under the scheme of the state government. Part one. And the second, the Uday, which was referred to, was essentially a financial restructuring program where to reduce the overall debt burden by providing the subsidy, and which essentially was to improve the operating efficiency. So one part was that whether is this grant in nature of for the assets or they are in nature of income. And in both the cases, as we saw, that it was not with a view to acquire any asset, and therefore these grants are related to income, and therefore all the consequential provisions of the EAC 20 in terms of its timing and its recognition and measurement and disclosure will flow in. Having therefore come to the conclusion that this is the grant in nature of an income, then now comes a question that there are a paragraph 19 also of Ind AS 20, which essentially talks about that they are received as a part of a package of a financial or a fiscal aid with number of conditions are attached, and Vivek just read out that the queries did mention that subsequent to the receipt of the money, the queries company will comply with the conditions attached to that. And it may be, and therefore paragraph 19 also deals that you can have a dual treatment to a part of the amount received. So it may be appropriate to allocate part of the grant on one basis and the part on another. That is also the paragraph 19. Now, coming therefore, the fundamental principle of paragraph 7 of Ind AS 20 is that when can you recognize the grant as a receivable, which says that the entity will comply with the conditions attaching to them and the grant will be received. Now, these are the two fundamental principles before the grants can be recognized. Now, from the fact pattern, it is very clear that there was a true up by the State Electricity Regulatory Commission, SERC, from 2008 onwards. And the money, therefore, which came was already in respect of the power which the DISCOM had already supplied in the respective years. So therefore, the subsidy received in return of compliance with certain conditions, including supply of power at subsidized rates or concessional rates, was already met. And therefore, in terms of paragraph 7, the subsidy should have been recognized as and when the power was supplied and there was reasonable certainty of receipt of the subsidy. And the one portion of only because the money is coming in installments does not mean that you defer the recognition of the subsidy to in installment basis. So that is the first part of the opinion which was to be considered, considering paragraph 7, considering the fact that this is income, power has been supplied, the amounts have been finalized. Only because it is coming under installment does not mean that you defer the recognition of the subsidy in installments. Now, coming to the second aspect, which was in respect of the Uday. And this is the area where if there were conditions which were yet to be complied post receipt of the money, then to that extent the grant would be recognized by way of liability. However, if there are no substantive conditions related to the grant to be complied with, and there is a reasonable assurance about receipt of the grant with the order of the state government in 2021, even though no funds were received, the subsidy should be recognized in the financial year in the profit loss account with a corresponding subsidy receivable. So now, and the third principle, which Avinash ji has very clearly stipulated, that there is no recycling. So therefore, anything cannot, which has to be amortized over a period of time, cannot be part of the other equity. This is the very, very clear principle, I think, for the benefit of all the audiences, that you can't have item in other equity, which is being recycled to the profit and loss account. So these were the, out of the queries, Vivek, these were the two answers which are considered by.
Thank you, Sandeep ji, for elaborately explaining on how these how the accounting would be done and how the reasonable assurance condition is required to be evaluated for the recognition of a particular government grant as an income or not. Dr. Chanda, would you like to add something to what Mr. Shah said?
Yeah, one thing I would like to add is actually the, here also the grant has been given by the owners. Okay. And it has been treated as within the scope of Ind AS 20. So for that, how it has been treated within the scope of Ind AS 20, for that, there is paragraph 14 of the opinion. Actually, for every opinion has this type of paragraph after in section C, points considered by the committee. This paragraph, which lays down the scope, presumptions, assumptions, etc., which must be read. So here the committee says that the committee presumes that these grant subsidies are not given by the government in the capacity of being a shareholder owner of the company, and it represents government grant as per Ind AS 20. So in this particular case, since the facts were not available, like in the earlier query, on that some documentation was available on the basis of which you can reach a conclusion that in what capacity it has been given. So in this case, those facts were not there. So therefore, the committee has made this presumption. So that is the reason why everyone must read this scope paragraph, which although it is not titled as scope paragraph, it is the first paragraph appearing within, in section C, points considered by the committee. So that is the first point which I thought I would highlight, that since we are considering grants throughout this evening, and different type, depending on different type of grant, we reach a conclusion. So here the committee has presumed that it is a government grant. And on that presumption, then it has gone to Ind AS 20. And within Ind AS 20, as Sandeep ji has very clearly identified, that it is of the revenue nature. And then when it should be recognized, the timing of its recognition depends upon the reasonable assurance and meeting of the conditions. So all those aspects, the principles will have to be seen. So broadly, that is the takeaway from that particular section of this opinion.
Thank you, Dr. Chandra. You always point out some places where we somehow miss, and that is the beauty of having a technical director that we as a panelist in the discussion on the EAC. Very wonderfully explained. I think the scope para, as we discussed, is very, very important. So scope or the limitation para which is there, and certain facts that we assume before we proceed with the opinion, before the committee proceeds with the opinion, is very, very relevant. And I think this is the first para you should read when you read an opinion, and this is the context basis or the boundaries within which the opinion has been given. So coming to the next question, Mr. Shah, considering that this is an error, if at all, how would this be considered from an Ind AS perspective? So if you could just throw some light on Ind AS on prior period errors, assuming there was an error which was there in the past.
Yeah. So as long as Ind AS 7 was complied with, obviously there is no error. But assuming that Ind AS 7 was not complied with, where the recognition was, the timing was not appropriate, then we do have the Ind AS 8, which deals with the prior period errors or the omissions and misstatement in the financial statements. And rightly it says that whenever that information was available for those periods were approved for issue and could reasonably be expected to have been obtained and taken into account in preparation and presentation of those financial statements. So in terms of the fact pattern as it is emerging, if there is an error, then it shall correct all material prior period errors retrospectively in the current period from 23-24 by restating the comparative amounts for the prior periods presented in which the error occurred, or if the error occurred before the earliest period, then the earliest prior period presented would be your presentation. And then further, there are disclosures under paragraph 49 of Ind AS 8 and also of Ind AS 1 for the third balance sheet at the beginning of the preceding financial year should be made. So that would be the treatment in terms of the period errors which have been discovered during 23-24.
Thank you, Sandeep ji, for elaborating. Coming to the next opinion, I think we can take up this opinion, and this is again something which we practically face. I'll just discuss the facts in very brief and come to straight Dr. Chandra for his views on this. So basically, the question that is being asked here is, how do we classify the amounts payable to employees. So basically, whether these amounts payable to employees for services rendered on account of pay and perquisites would be classified as trade payables, or would be classified as under the head other current liabilities, or would be classified as provisions. So Dr. Chandra, I would like you to first deliberate on whether these would possibly employee benefits payable can be classified under the head trade payables, one. And second, how do we differentiate between a provision and a liability? So these are the two facts which I would like you to, two queries which I would like you to discuss. And I think it's more of a principle-oriented opinion. So I'm not getting through the facts. So I would request you to straight come to the opinion.
Yeah, actually, it is from the perspective, primarily from the perspective of Schedule 3, that how we classify the accrued wages and salaries, whether these have to be disclosed as trade payables or other current liabilities or provisions. Now, here the committee has gone into the requirements of various standards. Firstly, Ind AS 19, which requires that if there is an undiscounted amounts payable to the employee for rendering short-term employee benefits, it is to be considered as a liability. So it is to be considered as a liability. So that is the requirement of Ind AS 19. 19 does not say that it is a provision. Why this paragraph has been referred to is for the fact that this is not a provision, it is a liability. Then the question arises that whether it is, because trade payable is also a liability, and some other liability, I mean other financial liability is also a liability, then how it is to be classified. For that paragraph, standard Ind AS 37 has been referred, which says that the provisions have to be distinguished from other liabilities such as trade payables and other accruals, right? So the standard 37 itself says the accruals which could be trade payables and other accruals have to be distinguished. And then the standard 37 goes on to say, trade payables are liability to be paid for goods or services received or supplied. And the amounts, the accruals are the liability to pay for these, the goods or services. And it is specifically mentioned therein that it includes amounts due to employees. So therefore, the provisions are not amounts due to employees. Then another thing which is included in this para 37 is that accruals are often reported as part of trade and other payables, wherein provisions are reported separately. So therefore, if there are some trade payables, they are not provisions. If there are other payables like employee benefit, they are not provisions. Provisions have a greater amount of uncertainty involved, whereas in case of accrual, the uncertainty is not there, or to that extent as in the case of the provisions. Then paragraph, there is guidance note of the Institute on Division 2 to Schedule 3 that also says current liabilities will include items such as trade payables and employee salaries payable. So trade payables are different types of current liabilities, and employee salaries payable are different types of liabilities. So this guidance indicates that employee salaries are different from trade payables. They are not part of trade payables. Similarly, paragraphs 40K and L of Ind AS 1, read with para 17, it says accruals or payables for employees to be presented separately from provisions and trade payables. So something which is to be paid to the employees should not be part of the provisions and trade payables. So keeping in view all these requirements, the committee reached the conclusion that any accrued wages and salaries due to the employees should not be part of trade payables, should not be part of provisions. It should be part part of other financial liability or other liabilities, or maybe you can create a separate head also if you so desire, but not as trade payables or provisions. So that was the basic conclusion.
Thank you. Thank you, Dr. Chandran. Any quick comments, Mr. Shah, on this?
No, I think rightfully the paragraph 11B was referred that while there may be some uncertainty around the timing and the quantum of this approval towards the fact pattern on the wages, and there were certain estimates, but that does not necessarily make it into a provision. I mean, that of India is 37, I think what Vinash is saying is the correct approach. Only because you are estimating does not make it a provision.
Yeah.
Thank you.
That part is important.
Thank you, Mr. Shah and Dr. Chandra. Wonderful to moderate such a erudite panel on the opinions which were shared by the committee. It has been a wonderful experience and a great learning for me, at least. I think the participants would also be very happy to learn about these issues, especially on government grants. I think so many issues were brought out in the opinions that were discussed, which we somehow miss when we forget or when we overlook the fine print in the standard. Over to the office for their final comments.
Yeah, thank you, sir. Thank you all for joining today's webinar, and we really appreciate your time and engagement in the webinar. We extend our deepest gratitude and sincere thanks to our eminent speakers of the webinar today, Dr. Vinash Chandran, CA Sandeep Shahji, and CA Vivek Nevatia ji, for steering today's webinar. I'm sure that the views expressed in the panel discussion were quite insightful and gave guidance on many relevant issues, and believe that the deliberations at the panel discussion were of quite help to the participants. We are sure to give the benefits of EAC expertise in the future as well. Thank you, everyone, and good night. Thank you.
Thank you. Thank you.